Hello and welcome to episode 320 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, how are you doing?
I'm good, Andy. It's another very positive week in the Money to the Masses towers. We've been doing lots of content, and some of the content we've been producing is on this week's show. And the other thing that I am positive about is that I'm going back to White Hart Lane. Well, it's not White Hart Lane, it's the Tottenham Hotspur Stadium, to give it its correct name, next week to watch Spurs against Villa. So that's a real progress in the COVID world. So that's a positive. So me and Justin are buzzing about that. So if there's anybody else going up to Tottenham next week, then maybe we will see you there.
And not to bore too many people about our football stories, but there's no shying away from the fact that we're both fans of our relevant teams. You're obviously a Spurs fan. I'm a Watford fan, so I'm just going to put it out there that I'm still bouncing on cloud nine, to use a football phrase, because Watford got promoted back to the Premier League, where they deserve to be, of course. And we'll be playing each other next season.
Yeah, so they did it in style, though. So Andy's been boring me with the stats about how good Watford's defence was.
Absolutely, record levels of clean sheets is what they call them in the football world, for those who aren't bothered.
Yeah.
But we've got good defence, is what I'm saying.
Yeah, so we're not a football podcast, but Andy's positive for that reason. I'm vaguely positive that I'm going back to Tottenham. Not that I'm happy about what's going on at my club. Maybe I'll be taking my Levy out poster to the ground. No, I won't, but I'm not particularly happy about what's going on at the club. So, but it's still good to go back. It just feels the world is getting a bit back to normal. And that leads on quite nicely onto one of the things that I'm talking about on the podcast, actually, holidays. So everybody, not everybody, but people are talking about holidays. We had the green list, didn't we, of countries that we could travel to without having to quarantine when we came back. And off of that trend, the idea of booking a holiday is coming to the front of people's minds. And there is a trend now to use buy now, pay later services for booking a holiday. And actually the term has been coined fly now, pay later. And I'm going to do a piece on the podcast about that trend and the good and the bad of it. And in fact, I'm going to give away a bit of it. There's nothing good in my view, but I'm going to talk about why people need to be careful. The other thing I want to talk about on the podcast this week is mortgage tipping points. Now, more importantly, how to clear your mortgage earlier. So it's something I've been asked about by a listener. I would say it's Sarah out there sent in a question. Actually, she won a mug as well this week. So she's had a really good week. You think you and I have had a good week, Andy? Sarah is absolutely buzzing, because not only has she got a Money to the Masses mug, I'm answering her question on the podcast. And the final piece, Andy, you're going to be doing?
I'm going to be covering business insurances. Last year was one of the biggest years on record for new businesses starting out, where people diversified and changed direction. Well, I'm going to help those people out to decide on what are the top insurances new businesses should consider.
So this week I was asked by one of the national newspapers about my view on this new fly now, pay later concept that's come out. Now, there is a company using that name as its brand, but I'm talking more loosely about the concept. So in the US, there has been the idea of using buy now, pay later services to buy holidays. Now, if you go back to episode 261 of this podcast, we actually talked about buy now, pay later services in general. So go back and listen to that, where we talk about the pros and cons. But today, I want to talk about it in relation to booking holidays. Now, the idea of paying for holidays in installments isn't anything new. It's a big ticket item, and that idea has been around before, where you have the holiday companies allow you to pay for holidays in installments. But what's been happening of late, and why it's in the news, is that companies like lastminute.com have signed up with services. One of them is called Fly Now, Pay Later. So when you're at the checkout, you can use that payment option to buy a holiday that you maybe couldn't afford otherwise, and pay for it in installments over a period of time. So some of the attraction, for example, the headline rate would be no interest, and you might be able to pay for it over, say, 2 to 3 months, up to maybe a year in equal installments. This concept has been around, like I say, in the US. We have seen something like it in the UK. There is a company called Butter that is like a buy now, pay later travel agent. At the moment, they have flights on there, but apparently there is plans to have more holidays on that particular site. As a concept, what tends to happen with buy now, pay later services that are associated with holidays is that you can pay in installments and there won't be that interest. If you look at it though, there can be late fees on these things. So even if you use them and they might say it doesn't impact or hurt your credit score, the fact that they can charge you late fees, that inevitably can impact your credit score somewhere down the line. So your credit report. Don't forget, there's no such thing as a universal credit score. You've got a credit report, a credit file that companies will use to decide whether they want to lend to you and create credit scores. Experian and people like that will do their own credit scoring to give you an indication of what sort of level you're at, how good your credit rating is, but there's no universal credit score. Now, be careful when you're looking at these services. They might seem attractive. You're desperate to go on holiday because we've all been locked up for a year, and you see a holiday and you see this option, I can pay equal installments. As a concept, I want to throw out some warnings because you have to be careful because you could be entering into like a credit arrangement, a credit agreement with these people. So some of the services you will be credit checked when you go through there. It can also give you a line of credit, which is effectively what they're going to be doing. They give you a line of credit which will pay the holiday company. You'll then sign up to a credit agreement with them to pay installments over time. Now, with some of the services, what will happen is that you will have a credit check, and depending on that, then you may have to pay a transaction fee, effectively a fee, a one-off fee up front that will pay for the ability to have this credit line. And there can be a deposit or other charges as well. Now, one of the services that's been talked about at the moment in the press is one called Fly Now, Pay Later. That is its brand name. Now, if you look at that website, one of the examples they give on their site states that if you have a £800 holiday, then there can be a £136 one-off fee, taking the holiday price up to £936 in total. So you've paid the upfront fee and then you've got the £800 split into equal installments. If you work out that number, the £936 versus the £800 cost of the holiday, that works out as a 51.8% APR. That's expensive. That is 3 times the average UK APR on a credit card. I mean, that's not even a good credit card. That's just 3 times the average. So it's a very expensive way to try and fund a holiday. So I know people may be desperate to go on holiday, may be drawn to using buy now, pay later services to purchase a holiday, but they can be a very expensive way to borrow. Don't always gravitate towards the headline rates, the 0% headline rates that they say. Now, the other thing, if you look at the buy now, pay later services that are out there and you look at some of the reviews surrounding the holidays I'm talking about, ones that are being used specifically for holidays, there are some questions that I look at this stuff in great detail. Laura, who's on the team, who heads up all our credit stuff and writing, she was looking into this. And it's very difficult to pin down exactly the sorts of protection that consumers have. Now, because with these services, you are ultimately entering a credit agreement, then what happens if you need a refund? So last year was a good test bed for some of these services. So the holiday didn't happen, you'd want a refund. When you look at the reviews of some of the services out there, it seems to me the middleman that's created by using a buy now, pay later service, that causes the refund to be delayed. So there are people who, when you look at the reviews, are saying that, yes, it breaks the chain. The refund goes via the buy now, pay later service, and people are unhappy about the time it's taken to receive the refund. But of course, they are also at the same time tied into a credit agreement that they may have had, an agreement to keep repaying the money, because they have agreed to pay installments for the holiday. They've taken out some money. That money's gone and paid the holiday company. So they are waiting for a refund for a holiday they've not been able to go on because of COVID, yet they're still paying for the holiday in installments under that agreement. That isn't a scenario you want to be in my view. There is a question mark about atoll protection as well on these holidays. Because you're breaking that chain, I would get in touch with any company if you're thinking about using these services and questioning whether you get atoll protection on the holiday. Question the protection you have as a consumer because you're using credit. Now, if you use a credit card to buy a holiday, you automatically get the Section 75 consumer protection. So under the Consumer Credit Act, you get protection that if you buy something that's worth between £100 and £30,000, so as long as you pay an amount between £100 and £30,000 on your credit card. It doesn't have to be the full amount of the object in question. You can just pay for part of the holiday. So you could pay £200 of the holiday on a credit card. Then you get protection up to the full value of that holiday, up to £30,000, should the holiday company go bust, for example. So you've got that extra protection in place. Well, with buy now, pay later services, they aren't typically regulated under the Consumer Credit Act. So there's a big question mark that whether you get any of that protection, despite the fact you're borrowing money. On the face of it, it doesn't look like you do. So you'd have to question that buy now, pay later service that you would use to purchase the holiday. Ask them whether you have got that protection. Because like I say, on the face of it, on the surface, it's questionable whether you even do. So obviously, if you can afford to buy a holiday, in monetary terms, it makes sense to pay for the money out of money that you saved. In this environment, obviously, using a credit card to buy a holiday makes sense because of that extra protection, and then you just pay off the credit card immediately. If you can't afford to do that and you're going to go on holiday, then it makes sense to have a 0% purchase credit card. Use a 0% purchase credit card to be able to buy the holiday and then pay it off in installments within that window, that 0% purchase window that you've got, that could say be maybe 18 months, and then you can clear the holiday. That would be a far better way, in my view, of using credit sensibly to purchase a holiday if you really have to go on holiday and you have to use credit. It's better off not doing it if you can't afford it. But if you're going to, we're all adults, it's better to do it that way, because not only are you using credit sensibly, you're also getting that consumer protection. But the other thing, you know how this works when it comes to insurance and travel insurance as well. There's question marks again when you're using these buy now, pay later services, how they work in conjunction with the travel insurance that you have if the holiday doesn't happen. So there's a lot of question marks around the whole area. Personally, I wouldn't use them because I think there's too many question marks. There's a much simpler route, if you want to go down that road, of using a credit card and paying off over installments like a 0% purchase credit card. People might say, yeah, that's going to make a mark on your credit report. Yes, it will do. Of course it is. You're going to take out a credit line. But there is the same argument leveled at these buy now, pay later services, because if down the road you make a late payment, ultimately these things can impact your credit report too. So it's better to do it sensibly and know what you're getting yourself into. I think it's a slightly muddy grey area with these buy now, pay later services. So I would steer clear.
Okay, moving on to mortgages and repayments and trying to understand, the best sort of way of paying off a mortgage. What's the tipping point? Should you overpay? You're going to kind of cover off a few questions from a listener by the name of Sarah.
Yeah, so the question that was sent in is, would you do a piece on the show about how to work out how much of a mortgage payment goes to principal and how much goes to interest? And then she was asking about how overpayments work and basically what is the tipping point when we're looking at these things. And it's a very interesting question. And it would make probably the most boring podcast on the planet if I sat there and told you what the actual formula is to work it out. And just to explain to people what Sarah's asking is, if you pay a certain amount a month on your repayment mortgage, so let's say you pay £1,000 a month, then a certain amount is going to go to interest, and some of it is going to go to pay back the loan that you've actually taken out, the mortgage you've taken out. And that number, that differential is not constant. So it's not £500 and £500. It starts off heavily skewed towards the interest that's on the mortgage. And then it starts to change over time, that the £1,000 you pay a month, the split starts to slowly move towards you paying off more of the principal. And there is a tipping point. It's a crossover where eventually, when you're paying your monthly payments, because they're fixed, they stay the same, £1,000 in my example, at some point, more money is paying down the loan than is actually going towards funding the interest that you're paying over time. So how you work that out, so if you're listening to this podcast, how you can personally work it out for yourself is, there is a good calculator that I found online that does this, and it's called calculator.net/amortization. So that's amortization-calculator.html. So of course we'll put a link in the show notes, but this is a calculator that's based in dollars, and that amortization it appeals to the inner geek in me, because as soon as Sarah asked the question, I knew that's what she's asking and could go and look and find a calculator by putting that word into Google effectively. The calculator, if you go and find it, very simple. You can punch in the size of the loan, the term of the loan, and the interest rate you're paying. So I will go there and I'll give you a couple of examples to explain this concept to you. So if you think of the average house price in the UK is about 250 grand. So let's keep it simple. Let's say there's a mortgage for £250,000 over 25 years with an interest rate, and we'll pick one at 5%. I remember when I bought my house, that is a typical example. It was about 5% interest rate on a mortgage. That obviously is pricey now, given the mortgage rates, but just to give you some numbers, if you were to take out a mortgage on those terms, 25 years, £250,000 with a 5% interest rate, your monthly repayment would be £1,461.48 a month. And of that, the split would be £1,041 would be paying the interest, and £420 a month would be paying the principal, so paying back what you owe. So you can see that you're not paying back much of the loan. That's the way this works. That's why mortgage companies love lending us money, because they make a lot of money. Over the lifetime of that mortgage, when you eventually repaid it, you would pay a total of £438,000. So it's £438,442 for a £250,000 loan. That means your total interest you paid back was £188,442. So 250,000 for 25 years at a 5% interest rate. That is a big sum. Now, if we take that example and we look at it from Sarah's perspective, where she was asking what's the crossover, because as I said at the beginning, only £420 of your £1,400 a month payment is actually paying down the loan. The rest of it, over £1,000, is paying the interest that you're accruing over time. The crossover, almost tipping point, if you look at the numbers, is 11 years and 3 months. At 11 years and 3 months into your mortgage, that is the point where you start paying back your monthly payments. More of it is paying back the principal, the amount you've borrowed, than is going on the interest payment. And that means from beyond that point, what happens, you start to see a slight acceleration in terms of the amount you pay off on your loan. Because in the first year of having a loan, like I've said, with a 5% interest rate, you're actually paying off about £5,200 off of your loan in the first year. That's all you're paying. Your balance on your mortgage is £244,845. But in the last year of you having a mortgage, you'd actually pay off the last £17,000 in the last year. So you can see, wow, first year, you're barely paying off £6,000. In the last year, you're clearing £17,000. So that's the way it speeds up. You can see the difference. That's why mortgage companies like lending us money. Of course, if we change the numbers and we start to become a little bit more realistic, we said that tipping point, that crossover where you are now clearing more of your mortgage a month than you are paying in interest, is 11 years and 3 months on a 5% mortgage. On a 4% interest rate mortgage, that drops down to 7 years and 9 months. If your mortgage rate is 3% and it's still those same broad terms on average, £250,000 borrowed over 25 years, if you get down to 3%, within 2 years, you are paying more on the principal than you are on interest. So obviously that's the reason why you want to remortgage, because if you get a lower interest rate, then not only can you end up paying less a month, more of your money is paying off the principal than you are paying in interest each month. So this starts to lend itself to like us looking about, well, wanting to clear your mortgage more quickly. And we've got an article on the website we're going to link to that talks about paying off your mortgage more quickly and overpaying on your mortgage. But just before I do this, one sort of kind of rule of thumb that's quite interesting is if you, on the example I said, so an average mortgage, £250,000 over 25 years, the percentage interest rate you pay, so if you pay a 2% interest rate, then around about 21% of all the money that you pay in entirety over the lifetime of that mortgage goes to interest. So interestingly, if you go to 3%, so you have a 3% interest rate, then it's nearer 30% of all the money you pay in totality over that term goes in interest. So it's almost a like for like. So over 1%, if you had a 1% mortgage for the entire time of your mortgage, then around about, it's not quite exact, but nearly 10%.
It's a good guide, yeah.
Yeah, sure. It's a good guide. So that's why, obviously, you want to keep remortgaging, because you want to try and keep that percentage of money you're giving to your lender on interest lower. But if we think about repaying your mortgage, okay, so obviously if you cut your interest rate, then you're going to pay your mortgage, potentially you could pay it back more quickly. That tipping point comes further forward. But the other thing you can do is obviously pay off lumps of your mortgage, because if you're paying off lumps of your mortgage, then you're reducing the principal. The one key thing though, if you decide I want to try and pay off a lump of my mortgage, Firstly, you've got to check whether you can or not, because there are often limits. Go back to podcast 219 when we talk about things to think about if you want to overpay your mortgage, because some of the mortgage lenders have restrictions, like you can't pay more than 10% of the outstanding balance off in one go. So there are rules. You're going to have to look at the T's and C's of your mortgage. But if you do decide to overpay your mortgage, one thing that you want to be careful of is that you want to make sure that you keep the monthly payments the same. Because if you paid off a chunk of your mortgage, your lender would probably want to reduce your monthly payments. It therefore ensures that you've got a mortgage for longer. Because if you suddenly take a chunk of the principal away because you've repaid it and you keep your payments the same, your monthly payments, you're going to start paying off your mortgage quicker. And actually what will happen is you'll actually clear your mortgage before you were actually meant to. So my example of 25 years, you'll actually clear it quicker. I want to throw some numbers out there just to give people an idea. So let's say, change the example slightly. You had a repayment mortgage of £100,000 over 25 years and a 2.5% interest rate. If you increased your monthly payments by £50, so you decided to do a monthly overpayment, then you would actually reduce the term of your mortgage by 3 years and 4 months. If that was £100 a month overpayment, you'd reduce the term of your mortgage by 5 years and 10 months. £150, it reduces it by 7 years and 10 months. £200, you would reduce your mortgage term by 9 years and 5 months. You can see that for every £50 I'm going up in this example, it's somewhere between 1 and 2 years that you're knocking off each time. By the time you get to £300 a month overpayments, you've knocked off 11 years and 11 months. So overpaying your mortgage, it might not seem a lot by doing £50 a month or £100 a month, but it makes a huge difference in the term of your mortgage. You will clear your mortgage far more quickly. You just need to make sure of the T's and C's. You don't breach any of them in terms of how much you're allowed to overpay. Otherwise, you will be penalised. There'll be a charge, probably some early repayment charge is what they will call it. But it just shows that there are tipping points on mortgages, but you can clear it more quickly by just doing small overpayments or obviously reducing your interest rate. The other thing you could do is there are people who just remortgage. If you remortgage and actually reduce the term of your mortgage, that will obviously clear your mortgage because you're actually committing to paying in a much shorter time frame. So let's take that £100,000 example I said over 25 years with a 2.5% interest rate. Let's say you did reduce the term, you remortgaged. If you reduce the term, don't change any other factors like interest rate. If you reduce the term by 1 year, your monthly payments go up by £13. If you reduce the term by 2 years, that's an increase of £28. All the way down to if you decrease the term by 8 years, your monthly payments go up by £153. So you can see that, again, reducing the term deliberately will clearly pay off your mortgage more quickly, but it puts up the monthly amount. Now, you may sit there and think, well, that's kind of the same thing I said earlier. The difference is that with this way, you are committing to reducing your term because you've actually changed the product, you've changed the term you've agreed to. Whereas with an overpayment, there's a voluntary element to
It's
that.
a more sort of flexible
Yeah, so let's say
Yeah.
your financial circumstances change, then you could decide to not overpay. And of course, there are some mortgages out there that if you've overpaid, that will allow you to withdraw some of that overpayments. You'd have to check the T's and C's. We've got a whole article on it, how to pay off your mortgage faster and whether it's a good idea. There are other ideas, like you could use an offset mortgage, for example. So if you are one of those people who wants to get to the world of financial freedom and you want your independence, it pays to overpay your mortgage. Dave Ramsey, if you know Dave Ramsey in America, he loves a bit of mortgage overpayment. And if you can do it, then obviously, as the numbers show here, then you can be mortgage free much more quickly by paying a relatively small amount extra each month and by remortgaging and cutting your interest rate. So don't just leave your mortgage. Lots of people just revert onto their standard variable rate with their lender. Do make sure you review your mortgage periodically, especially if you're on a fixed term, you're about to come off it. So you can find out more about overpaying and clearing your mortgage more quickly by looking at the show notes where we'll link to the article.
It's really interesting stuff hearing about all those numbers and figures, and it kind of made me think about sort of balancing off whether it's better to overpay my mortgage or should I be putting money into savings or investments. How do you know what's best?
It boils down to, and in fact it's covered in this article so people can read it, but it boils down to the rate of return that you can get on the investment, and that you can't guarantee unless it's a savings account. And if it's a savings account, then you have to take into account the fact that you may pay tax on that interest rate. But broadly speaking, because we get a personal savings allowance now, that you need to be earning more interest than you can get on savings to make it better to save, theoretically, than to repay your mortgage. But, of course, there is a flexibility in putting money in savings that you can draw on it. But interestingly, the personal savings allowance will come into effect on this sort of stuff, because you're talking about larger sums of money. So basic rate payers get £1,000 a year interest tax free, whereas high rate taxpayers, they get £500 a year tax free. So it's all down to the interest rate that you have to look at. But for a lot of people, overpaying their mortgage makes a lot of sense if they want to become mortgage free sooner in this low interest rate environment.
Okay, and the final piece of the podcast, I'm just going to be rattling off a few insurances that you should be considering if you run a business. And I've written an article where I've listed 9. In reality, there's more than 9. There's tens of insurances that you could consider as a business. But these are 9 that I picked out, some because they're legally required and some because, having worked with Damien and knowing how money to the masses as a business works, they see and we see as really key. The first is public liability insurance, which is a type of business insurance that covers things like legal costs and compensation payments. It isn't legally required, but really any business that has regular interaction with the general public should definitely consider it. And I'm talking about businesses like hairdressers, restaurateurs, anywhere where you could have someone that's going to be trying to make a claim against you. You want to be able to mitigate that by having insurance in place. The next one is employer's liability insurance. And this is an insurance that as a business you'll need to have in place in case there's any claims made against you, say from your employees. Let's say someone fell over and while they were working for you and made a claim against you. And this is a type of insurance which is legally required. And actually, as a business, you can be fined for not having it. And fines can be up to as much as £2,500 for every day that you're not insured. So it's a really important insurance to have as a business. The next one is key man insurance, which is a type of insurance that will protect against the death of a key employee within your business. And this can help to protect profits and cover debt and pay for the cost of replacing key staff members. This isn't a legal requirement, but if you're a small business that puts a lot of emphasis on certain members of staff and you rely on those, if they weren't just suddenly going to be around, then you may struggle to be making money straight away. And so you want to replace.
Yeah. And I mean, to give people examples, that I have no qualms of saying that we have key man insurance, because if you have people who are integral to parts of the business and they were to get hit by a bus, God forbid, then you've got to go and find somebody of equal standing in terms of ability, and you have to pay them a wage to come and work for you. Then how would you do that? How would you acquire those people? This enables a business to continue. These are important insurances because of the continuity of a business that you need. And I mean, the next one Andy's going to go on to, which I've kind of jumped into here, but shareholder protection. Again, it's something that we have as money to the masses, that if you have people who, if it's part owned and you have shareholders, it's more about your other half. So let's say you had a partner in a business and they're shareholders and that director died, then you've got to look at what's going to happen in that instance. And in that instance, then you could end up having a spouse of that person suddenly becoming an owner in the business, that you might not actually want that to happen. But more importantly, what you might want is, as a director or shareholder yourself, you might want your spouse to be able to effectively cash in on what would be your share of a business and be able to get on with their life and not have all that hanging around them and have to be part of a business which you are no longer, obviously you're dead, you're no longer got any interest in as a family. So they will end up being paid out money, which effectively can then be used to purchase your share of the business and for your benefit really of your spouse.
Out of all the insurances we're going to cover, that's probably one of the key ones to consider, because it's got that dual benefit of looking after the key family members within the business, but also to protect the business going forward. You really don't want to have a business where disinterested or family members that have no knowledge of the business come in. It can be really damaging.
Yeah, and the other thing, I just quickly before we move on that one, Andy, there are people out there who listen to this podcast who spend their whole life working really long hours growing a business, and then that is probably in their own way one of their biggest assets. It's tied up in that business and it produces an income. If they're not there, that business, they're not going to have the income coming from that business. And it's an asset that is of no use. They need to get the value from that asset. That is one of the ways. And it's one of the ones that I think most people never think about. So if you have a business and you're in partnership with somebody in that business, so you've got shareholders, your directors in that business, something to definitely look at and get advice.
The next one I'm going to cover off very quickly is income protection insurance. We've spoken about it on the podcast before. It's just one to consider. It will cover your income or your employees' income if they're unable to work. Product liability insurance is key if you supply products or services to people and they suffer an injury or loss resulting from that product or service that you supplied them. So it's not legally required, but again, to help mitigate any of those costs of being taken to court or being sued, get that in place. Professional indemnity insurance is a type of insurance that will cover you for anything you might get sued for. So if you're a business that is trusted to hold data or provide services to clients such as advice or skills, if they weren't happy and you damaged their reputation and made a claim against you, you'd have the finances and the resources to be able to cover and mitigate that. And the final two, business interruption insurance is a type of policy that will protect your business for any loss of sales or profits due to unforeseen circumstances. We're talking things like fire or flood. Again, not a legal requirement, but if you're worried about those kind of things, then get it in place. And finally, business commercial property insurance. And this is simply if you own the building itself, a bit like if you own a home, you take out home insurance. This is going to cover your business property for any issues relating to that property, like accidental damage, theft, fire, burst pipes, all of those kind of things. And at the start of this piece, I mentioned it was 9 insurances and there were many more. And almost just to prove that point, Justin shouted across the office to tell me to add another one in, which is relevant because it's becoming far more prevalent at the moment. And that's cybersecurity insurance. And it will cover your business if it is the victim of a cyber attack, for example, any security issues regarding data that's held on your servers and that kind of thing.
Brilliant. That's a great piece, Andy. So that's it for this week. As ever, contact us if you want to speak to us. Email us, damien@moneytothemasses.com, andy@moneytothemasses.com. As ever, we've always asked for the reviews at the end of the show. We should do it at the beginning. Please do send in the reviews. We had a nice review this week, which we do share them on socials. If you've given us a 5-star review, then do send in an email claiming it, because I'm still feeling generous in the mug front, so you can get the mug. So there you go. And as ever, join the Facebook group, facebook.com/groups/money to the masses, and do follow us on all our social media channels. So that is it for this week, Andy.
We're done.
Until next time.
Yeah, until next time. Spoke over you there. That's not a good way to end the podcast. The music's playing and we're done now.
Actually, I spoke over you during your whole piece, so we're more than even.